Cargojet shares fell today. The cargo carrier, aviation company, saw post a revenue that missed some expectations. Let's get more from Bloomberg's Stephanie Hughes. Thanks very much for coming on the show. What were the highlights here? Please, Stephanie.
Of course, Andy. So shares of Cargojet fell as much as 8.4% today, and that was the biggest intraday drop since March 2023. So it's been a while since we saw a decline of this magnitude. And it was also among the worst performers in fact, the worst performer on the TSX for a good chunk of the trading day today. And while the air cargo transport company came ahead of analyst estimates with adjusted earnings, its revenue and adjusted EBITDA lagged somewhat. But more importantly than that, analysts noted that the firm had been facing certain cost headwinds to cover overtime pay for pilots as it navigates growth and demand surges. Now, a demand surge does sound like a good problem to have, and National Bank noted that some of these costs should moderate over time, but they also added that certain industry-wide structural costs will be more permanent. And because of those permanent costs, management doesn't expect to see material margin expansion in the near or midterm. And that's exactly what's putting pressure on shares today, Andy.
Yeah, it's interesting. So their business carrying freight between China and Canada is growing, but startup costs, mechanics and all that eating into profits. You're also watching a real estate-related stock, Colliers International?
That's right. So Colliers, those shares fell nearly 7% today for marking the biggest intraday drop since February. And it's for a similar kind of third quarter earnings issue there. So it's another earnings story here. The problem is that the real estate company's adjusted earnings of $1.32 per share came short of what analysts were expecting. Further to that, the adjusted EBITDA also came in below the street's estimates. Management also trimmed the full year 2024 guidance for earnings and EBITDA quite significantly. So for earnings, they had been expecting a growth range between 11 and 21%. That was the previous range. Now they're looking at somewhere closer between 6 and 12%. So quite a reduction there. So the lower guidance does reflect the results this quarter and lower expectations for fundraising. The Scotiabank team said they were expecting the stock to underperform the broader index given these results today and because of recent price moves. And it looks like it's exactly what happened there, Andy.
Thank you very much, Stephanie. Bloomberg's Stephanie Hughes.